For the better part of 3 decades, we have been told that wealth is an abstraction. We've watched as value migrated from the physical gold bars in vaults and deeds to fertile land, into the ethereal lines of code, digital ledgers, and complex financial derivatives that exist only on a server. This was the era of pure software finance. It was a time of perceived limitless scalability, where growth was decoupled from the constraints of the physical world. But as we cross the threshold into the mid-2020s, that illusion is beginning to fracture. We are witnessing a quiet yet violent return to the physical. If you look closely at the market shifts between 2021 and 2024, you see it. The digital gold narrative is no longer enough. A private key is useless if the screen won't turn on. A ledger is irrelevant if the cooling fan stops spinning. We are entering a new epoch where the distinction between the financial system and the electrical grid is evaporating. This is not about the next speculative bubble. This is about the thermodynamic floor of value. For the long-term investor, the man who prioritizes the next 20 years over the next 20 days, the most significant hedge against institutional instability isn't just a digital asset. It is the copper, the turbines, and the sovereign power infrastructure that sustains it. Welcome to the horizon. Today, we analyze why the grid is becoming the new mint. To understand where we are going, we must acknowledge the end of the software-only era. Between 2010 and 2020, capital flooded into light assets, SaaS companies, social media platforms, and digital currencies that required very little in terms of physical overhead. This led to a sort of intellectual laziness in the markets. We forgot that every bit of data processed is a physical event occurring in a physical location. Starting around 2021, the world hit a wall. Supply chain disruptions were the first tremor, but the second was more profound. The realization that our digital ambitions have outpaced our electrical reality. The surge in demand for high-performance computing, driven first by the maturation of decentralized networks and then by the explosion of generative AI, has turned energy from a background utility into the primary constraint of capital. We have shifted from a world of speculative code to a world of physical constraints. If the last 20 years were about who could write the best algorithm, the next 20 will be about who owns the electrons required to run them. We are moving past digital gold toward what I call thermodynamic sovereignty. This brings us to the most significant threat facing the established investor today, the counterparty contagion. In our quest for efficiency and scale, we have created a financial ecosystem where too big to fail is not a badge of honor, but a single point of failure. When you trust an institution, you are not just trusting their balance sheet. You are trusting every entity they are connected to. Modern finance is a web of counterparty risk where the failure of a single obscure node can trigger a cascade that threatens the private wealth of individuals thousands of miles away. For the investor who has spent 40 years meticulously building a portfolio, this is an unacceptable vulnerability. We have reached a point where the size of an institution actually increases the entropy of your assets. The more layers of management, the more regulatory complexity, and the more derivative exposure an institution has, the further you are from the actual source of your wealth. We saw this in 2008, and we saw echoes of it again in 2023. The safety of the collective becomes the trap for the individual. If your wealth requires the permission of a third party to be accessed, or if its value is contingent on the solvency of a board of directors you've never met, then you do not truly own that wealth, you are merely renting a promise. This is the contagion, the realization that institutional trust is a fragile, human construct prone to error, greed, and systemic collapse. For the sober investor, the question is no longer which institution can I trust, but rather, how can I remove the need for trust altogether? The transition we are witnessing is a fundamental pivot from who to how. We are moving away from the era of institutional promises and toward the era of mathematical proof. To the uninitiated, this may sound radical, but to the analytical investor, it is the ultimate form of conservatism. Mathematical proof does not require a board meeting. It does not require a government bailout. It does not have bad quarters or conflicts of interest. An immutable open-source protocol operates on the laws of mathematics, laws that are the same in London as they are in Tokyo, and will be the same 100 years from now. When we talk about protocol-based security, we are talking about assets that are secured by encryption rather than by a legal contract. A legal contract is only as good as the court's willingness to enforce it and the counterparty's ability to pay. Mathematical proof, however, is self-enforcing. It is a system where the rules are the ruler. For the investor over 40, this shift represents a return to true asset sovereignty. It means moving your wealth from a system governed by the whims of men into a system governed by the certainty of logic. In this new standard, conservatism is defined by the elimination of intermediaries. By trusting the protocol, you are not taking a gamble on a new technology. You are making a calculated decision to place your capital on the most stable foundation ever devised by man. the cold, impartial, and unbreakable reality of mathematics. This is how we move beyond the vault. We stop looking for bigger buildings and start looking for better proofs. For the established investor, conservatism has always been synonymous with low risk. Historically, we minimized risk by outsourcing it to institutions with large balance sheets and even larger reputations. We believed that if a bank was old enough or a vault thick enough, our wealth was safe. But we must distinguish between perceived safety and actual security. A legal contract is not a physical barrier. It is a promise to litigate in a system that may or may not be functioning when you need it most. In Section 5, we explore the new standard of conservatism. When we speak of holding your own keys, we aren't talking about a hobby. We are talking about replacing the fragility of human-led institutions with the mathematical certainty of encryption. In the legacy world, your assets are entries in a database owned by someone else. You are a creditor to your bank. In the protocol world, your assets are cryptographic proofs. There is no board of directors that can vote to freeze your math. There is no too big to fail, because there is no counterparty to fail. For the man who has spent 40 years building a legacy, the most radical move you can make is to continue trusting a system built on promises. The most conservative move is to transition to a system built on proofs. Math does not have a bad quarter. Math does not succumb to political pressure. Math does not require a bailout. This is the shift from, who do I trust, to what can I verify? It is the ultimate evolution of risk management. Let's be intellectually honest. The transition from institutional reliance to self-sovereign security can feel daunting. We've been conditioned to think that if we hold the keys, we are the single point of failure. While true, we must weigh that against the systemic failure of the institutions themselves. To hold your own keys is to trade counterparty risk, which you cannot control, for operational risk, which you can. This is a deep dive into the math of encryption versus the fragility of legal contracts. A contract is only as good as the court that enforces it. Encryption, specifically the kind guarding the world's leading decentralized protocols, is backed by the laws of thermodynamics. To break it would require more energy than is currently produced by the human race. When you move your wealth into a self-custodied environment, you are essentially moving it behind a wall that no government, no bank, and no economic crisis can scale. You are no longer asking for permission to access your labor. You are exercising your right to own it. For those of us over 40, we understand that true peace of mind doesn't come from having a guy at the bank. It comes from having a system that works even if the guy is gone. Transitioning to this new standard does not require a reckless leap. In fact, the most prudent path for the established investor is a sober, phased migration. We call this the hybrid model. It begins not with selling your traditional portfolio, but by establishing a secure, self-sovereign base layer for your most critical assets. This isn't about crypto-bro volatility. It's about infrastructure. You start by educating yourself on the hardware, not the price action. You learn how to generate and secure a seed phrase with the same meticulous care you'd use for the deed to your home. You move away from the noise of the 24-hour news cycle and toward the signal of long-term preservation. A hybrid model means you might still keep your checking account for daily utility, but your deep wealth, the capital intended for the next generation, begins to migrate into protocol-based security. We are looking for redundancy. By diversifying away from 100% institutional reliance, you are creating a financial air gap. If the traditional banking system experiences a lost decade or a period of heavy capital controls, your sovereign assets remain liquid and accessible. This is the strategy of the informed peer. We do not gamble on the future. We prepare for its eventualities. Section 7 brings us to the ultimate goal, the 100-year horizon. Most wealth is lost within 3 generations, not because of bad investments, but because of friction. Probate, inheritance taxes, legal disputes, and the slow decay of institutional gatekeeping. Protocol-based wealth solves the problem of generational transfer by removing the middleman from the equation. When your wealth is secured by math, the transfer of that wealth to your heirs becomes a matter of information transfer, not legal permission. This is permissionless legacy. It allows you to ensure that your life's work remains intact, regardless of the political or economic climate your children inherit. In a world where debanking is becoming a tool of social and political policy, the only way to guarantee a legacy is to ensure that legacy doesn't require a third-party stamp of approval. We are moving from a world of trust me to a world of verify this. For the man over 40, this is the final piece of the puzzle. You aren't just protecting your wealth for yourself. You are building a bridge for those who come after you. A bridge made of unbreakable logic. We conclude with the realization that the sovereign investor is not a radical or a rebel. He is the ultimate evolution of the conservative steward. He understands that the world has changed, and that the marble pillars of the past are now just digital facades. By shifting your trust from people to protocols, you aren't taking a gamble. You are acknowledging that in a digital-first economy, mathematical proof is the only reliable form of preservation. It is sober. It is quiet. It is absolute. This is how we move beyond the vault. We stop looking for bigger buildings and start looking for better proofs. The horizon is clear for those who choose to see it. Thank you for walking this path with me. This is the horizon.